Good morning, everyone, and welcome back to the Peterson Institute for International Economics. I'm the Institute's president, Adam Posen, and it's our pleasure today to host a virtual speech by Randal K. Quarles, chair of the Financial Stability Board, member of the Board of Governors of the Federal Reserve System, and vice chair for supervision of the system. We will introduce Randy more properly in a moment. He has had a long and distinguished career in the U.S. Treasury and Federal Reserve, as well as in private financial markets. First, I just want to orient this talk in the midst of what we're calling Macro Week or March Macro Madness here at the Peterson Institute. Yesterday, we had the privilege to host the talk, the first public speech by Dr. Christopher Waller, the newest member of the Board of Governors of the Federal Reserve, where he spoke on the issues of central bank independence, particularly about emergency measures in a crisis and how the interaction between Treasury and Federal Reserve should go, his main message being that there will not be any consideration of debt financing issues by the Federal Reserve. Tomorrow, we're privileged even more, or as much or more, not to compare anybody, but just very excited to have Augustine Carstens tomorrow, Wednesday, March 31st at 10 a.m. Washington time, for a major speech on central bank digital currencies. Mr. Carstens, or I should say Dr. former Governor Carstens, is general manager of the Bank for International Settlements, a distinguished academic career and long service as the governor of the Bank of Mexico. Then we close Macro Week on Thursday, April 1st at 10 a.m. with the Institute's own Global Economic Prospects meeting, which many of you know is a semi-annual event coordinated and led by our colleague Karen Dinan, former Assistant Secretary of the Treasury for Economic Policy, and now a non-resident senior fellow at Peterson, as well as a professor of practice at Harvard University. I'm delighted now today to welcome the Honorable Randy Quarles. Just let me make sure I get his bio right, even though I think I remember it all. Randy took office as a member of the Board of Governors of the Federal Reserve System on October 13th, 2017. He was sworn in as vice chair for supervision on the same date, and that term as vice chair for supervision will end on October 13th, 2021, although his term as a member of the board continues for much longer. Importantly in the world, and importantly for today's talk, Mr. Quarles is also chair of the Financial Stability Board and took that office starting December 2nd, 2018 for a 3-year term. The Financial Stability Board is an international body that monitors and makes recommendations about the global financial system. It also coordinates national financial authorities and international standard-setting bodies as they work toward developing strong regulatory, supervisory, and other financial sector policies. Prior to his appointment to the Federal Reserve Board, Mr. Quarles was founder and managing partner of the Sinosure Group, a Utah-based investment firm. He previously had a very successful career as a partner at the Carlyle Group, a private equity firm based in Washington, D.C. In the term of President George W. Bush, Mr. Quarles served in a variety of senior roles at the U.S. Treasury, including as Undersecretary of the U.S. Department of Treasury for Domestic Finance, and as Assistant Secretary of the Treasury for International Affairs, as well as U.S. Executive Director of the International Monetary Fund. Previously, in the early 90s, he served at the Treasury Department as a Special Assistant to the Secretary of the Treasury for Banking Legislation and Deputy Assistant Secretary of the Treasury for Financial Institutions. You can all go back and find on the web easily the pictures of Jay Powell and Randal Quarles nearly 30 years ago testifying before Congress in their roles at the time. And now, of course, they are leading the Federal Reserve in an absolutely critical and pivotal period. Mr. Quarles is also a summa cum laude graduate of Columbia and earned his law degree from Yale in 1984. So let me now turn to our friend and colleague, the chair of the Financial Stability Board, Randal K. Quarles. Randy. You are muted, Randy. Let me see.
There we go. Sorry, the mute button was missing on my screen for a moment. Sorry about that. And thanks, Adam, for that introduction. It doesn't leave much time for the speech today, but thank you for that very generous introduction. And it's an honor and a pleasure to speak here at the Peterson Institute, which is a group that it's driven much of the most important discussion of international economic issues over my entire working life. I've always been engaged with it. I only wish that we could all be there in person. So perhaps soon. A little over 420 years ago, a crowd-pleasing local poet on a lightly populated island in the North Atlantic made popular a phrase that has entered our language. Beware the Ides of March. Caesar ignored the soothsayer, and the results weren't good. If recent history is any indication, maybe we should keep the warning in mind as well. In March of 2008, we witnessed a significant domino fall in a chain of events that sparked the global financial crisis with the collapse and sale of Bear Stearns. March of the following year saw the nadir of the Dow Jones average, a 50% drop from just over a year earlier. And the margin calls and liquidity crunch in March of 2020 were a salient echo of the other significance of the Ides of March for the Romans, the deadline for settling debts, which have had an unsettling habit of coming due in March in our recent financial history. In fact, this time last year, both domestically and internationally, the financial regulatory community fortified itself as COVID-19 and related containment measures spread across the globe, which I refer to as the COVID event. The Financial Stability Board moved into high gear, holding weekly, usually daily meetings with the most senior leaders of central banks, finance ministries, market regulators, to share information and to shape a synchronized global approach to the financial stability challenges at hand. This ability to spring into action on short notice is exactly why the FSB was established in the wake of the great financial crisis. Its mandate to promote international financial stability by coordinating the development of regulatory, supervisory, and other financial sector policies and actions at a global level reflected a recognition of the growing interconnectedness across our markets and economies. My focus today will be on the future and the challenges we face going forward, in particular, non-bank financial intermediation, or NBFI, and cross-border payments. These are only a portion of the FSB's comprehensive work plan, but they're priority areas that will have significant impact on the financial landscape going forward. So since the crisis of 2008, the non-bank sector has grown and evolved considerably. It accounts now, as you all know, for almost half of all global financial assets, and did so at the start of the COVID event. With this growth has come greater interconnectedness and complexity in intermediation chains. Even before the market turmoil of last March, the need to understand the vulnerabilities arising from the non-banking sector, as well as those from the banking sector, as well as those risks that had moved outside the banking system, was viewed as critical to achieving and maintaining financial stability. The March market turmoil helped focus our attention on non-bank finance and push the FSB to give further priority to work in this area. Because of the way this diverse sector is structured, developing an NBFI perspective requires bringing together regulatory, supervisory, and market perspectives and taking a broad view of how our financial ecosystem works. So even ahead of the COVID event, in my role as chair of the FSB, I formed a high-level group of central bankers and market regulators to oversee and coordinate work on NBFI, which by March was clearly a fortunate decision. Under the direction of this senior group, the FSB carried out its holistic review of the March market turmoil, which examined not only how different sectors of the market were affected, but also how those effects were transmitted throughout the system and which aspects of the financial system structure may have amplified stress. The holistic review underscored how vulnerabilities in the financial system amplified the economic shocks of the COVID event. In particular, it highlighted the dependence of the system on readily available liquidity and vulnerabilities if liquidity strains emerge in money market funds and open-ended funds, through margin calls, and in core bond markets. Importantly, the holistic review provides a high-level view on how these parts of the financial ecosystem operate and transmit risk while under stress. In my view, one of the most significant findings relates to money market funds. The holistic review documented how the extremely high demand for liquidity, combined with a flight to safety, triggered a dash for cash that hit institutional prime money market funds particularly hard. In the United States, prime money market funds publicly offered to institutional investors had outflows of roughly $100 billion, 30% of the fund's assets, over 2 weeks in mid-March. This was a faster run in terms of the percentage of fund assets redeemed than during the turmoil in September of 2008. Similar patterns were also seen in Europe, particularly for US dollar-denominated funds. Other funds that are active in short-term funding markets, such as ultra-short bond funds, also saw unprecedented outflows in March. The March market turmoil is the second time in roughly a decade that we've witnessed destabilizing runs on money market funds. More concerning this time, however, is that we've taken steps between these events precisely to reduce the likelihood of such runs. The FSB will publish a report in July for consultation that will set out consequential policy proposals to improve money market fund resilience. The proposal should also reduce the likelihood that government interventions and taxpayer support will be needed to halt future money market fund runs. This work will also consider the relationship between MMFs and short-term funding markets, with a particular focus on commercial paper and certificate of deposit markets and the impact of dealer behavior. Continued work on other open-end funds, margining, and bond market structure and liquidity will come on the heels of the MMF deliverables. As a first step, the focus will be on enhancing our understanding of vulnerabilities that could emanate from these sectors, including risk transmission channels. Addressing systemic risk in a dynamic sector that continues to evolve is no small feat. So I expect policy-related discussions and recommendations to follow the analytical work, and that will likely extend beyond this year. Although we don't really have enough time this morning for me to provide deep detail, I'd like to note that the disruptions in bond markets also raised questions about the role of leveraged investors and the willingness and capacity of dealers to intermediate in times of stress. So work is underway to gather data and analyze dealer behavior to develop a comprehensive view on their impact on financial market functioning and to determine whether policy responses are necessary. Turning to a different part of our NBFI work plan, the March market turmoil demonstrated the benefits that central clearing brings for global financial stability. In fact, central counterparties demonstrated resilience during this tumultuous period. But given their systemic importance, we continue to move work forward to improve CCP resilience and resolvability, as set out in our 2020 resolution report. So I'm coordinating with the chairs of the Committee on Payments and Market Infrastructures, of the BIS, of the International Organization of Securities Commissions, and the FSB Resolution Steering Group on shaping these details. We expect to launch a work stream this year that's aimed at further strengthening the resilience and resolvability of CCPs in default and non-default loss scenarios, including assessing whether any new types of resources would be necessary to enhance CCP resolvability. The FSB and other standard-setting bodies have also begun work on margin activity in centrally cleared and non-centrally cleared markets during the peak of the market volatility last year. We observed that margin calls by some CCPs may have been larger than expected. And obviously, while we need to ensure that CCPs are sufficiently margined, they're critical nodes in the financial system, clearing members and their clients also need sufficient transparency and predictability to be able to manage their exposures. To be successful, this broad and comprehensive agenda, which serves as a cornerstone of the FSB work program for 2021 and beyond, will require strong coordination, commitment, and resources from the international regulatory community, including at the FSB and other standard-setting bodies. Further, to ensure a sound, practical, and effective way forward, these work streams will also require transparency and engagement among the public. The FSB is therefore seeking the input of market participants and other parties. So this NBFI work alone would be an ambitious agenda. But I think the FSB is well equipped to address this challenge while also furthering the other important elements of our broader agenda. So let me spend some time talking about another of these important objectives, which is enhancing cross-border payments. In 2019, the G20 identified enhancing cross-border payments as a key priority and the FSB has been dedicated to advancing this important work ever since. The challenges associated with cross-border payments are widely known and long-standing, and prior attempts to make improvements have struggled to gain traction. In October of 2020, the FSB delivered a multi-year roadmap to the G20 leaders who endorsed the way forward and committed to advancing meaningful change aimed at increasing the efficiency and effectiveness of cross-border payments. Ultimately, we're focused on addressing the core challenges of cost, speed, accessibility, and transparency. It goes without saying that making improvements is easier said than done. Frictions underlying existing processes span multiple legal, operational, processing, technological, structural issues, and those can differ greatly by region. So to break down the magnitude of our task, the roadmap includes a set of practical actions designed to address specific topics, which we refer to as building blocks. We're taking a comprehensive approach and engaging the public and private sectors because both need to be part of the solution if we're going to achieve the ambitious goals we've set for ourselves. So to begin, we have to decide what the actual improvements are that we want to see and how we'll monitor progress in achieving them. These decisions will define the level of ambition, create accountability, and shape how the roadmap is put into operation at the global, regional, and national levels. As a first step, the FSB has formed a task force that's responsible for setting specific quantitative targets, and these targets will set the tone and pace for the work that follows and are therefore among the most important of the deliverables that we'll complete this year. We plan to publish a consultative paper in May and deliver a final set of targets to the G20 in October. Several groups are charged with advancing one or more of the building blocks in the FSB roadmap over the course of this year, with the FSB providing annual updates to the G20. We're collaborating closely with the Committee on Payments and Markets Infrastructures of the Bank for International Settlements, which has a key role given the position of central banks in the payments ecosystem. In addition to setting targets, the FSB is leading multiple elements of the roadmap itself, advancing those building blocks that are more exploratory in nature, for example, the soundness of global stablecoin arrangements. And on this particular topic last year, the FSB issued high-level recommendations for the regulation, supervision, and oversight of global stablecoins, and will report to the G20 this year on the progress achieved at both international and national levels. By their nature, cross-border payments are global. They involve many other countries outside of the G20 membership. We therefore have to be inclusive in our approach while remaining well organized to meet the milestones we've set for ourselves. And to that end, we've partnered with the World Bank and with the IMF, given their respective missions and their global reach. It will also be important to engage with financial institutions and service providers and industry groups, practitioners and academics as we advance this work. So we plan to communicate information and seek feedback through public consultations, conferences, and bilateral and multilateral outreach. The roadmap sets our path, but the practical reality is we need consensus among and action by many different and even competing stakeholders to achieve success. So we purposely build into the roadmap opportunities to course correct because we expect to learn more as we go. The FSB will report annually to the G20 Summit and to the public, sharing progress and seeking confirmation on the next steps for this immensely important and ongoing work. So what I've just discussed covers a large portion of the FSB's 2021 work plan, but I'd be remiss if I didn't mention a few other significant areas. We are, of course, continuing to closely monitor vulnerabilities stemming from the COVID event, including the rise in non-financial sector debt and measures of bond and equity market valuations. In April, the FSB will report on key considerations involved in amending or unwinding COVID support measures as appropriate. The FSB will play an important role once unwinding measures begins, given its work to support international information sharing on COVID-19 policy responses. We also plan to assess initial lessons learned from the COVID event for financial stability and to share those with the G20 in July. The COVID event has underscored the financial sector's susceptibility to operational risks, especially those related to cybersecurity. The speed of technological change and a growing reliance on third-party technology-based services is increasingly introducing new risks and vulnerabilities to the sector. So to begin to address this, the FSB is focused on achieving greater convergence in areas such as regulatory reporting of cyber incidents, and will deliver those recommendations to the G20 in October. Next month, the FSB will release the final report of its most ambitious evaluation of the effects of the post-Great Financial Crisis banking reforms. The report on too big to fail reforms is our most analytically rigorous evaluation carried out to date. When looking at these reforms, indicators of systemic risk and moral hazard moved in the right direction, and effective too big to fail reforms seem to have brought net benefits. In fact, at the beginning of the COVID event, we observed a far more resilient banking sector than that which entered the 2008 crisis. But if the benefits of the too big to fail reforms are to be fully realized, there remains further work to do, and we outline this work in the forthcoming evaluation. Further analysis of such reforms, international financial standards, agreed G20 and FSB commitments, recommendations, and other initiatives will provide us with better insights into whether the package of reforms are working as intended or conflict with another, are structured efficiently, and if they're in need of refinement. One last particular item to mention, LIBOR. Transitioning away from LIBOR is a significant undertaking that the FSB has been engaged in for almost a decade. The FSB set forth a roadmap for clear actions that financial firms and their clients can take to ensure a smooth transition away from LIBOR. And this year, the FSB will report to the G20 on ongoing progress and issues related to the LIBOR transition, including supervisory issues related to the benchmark transition. We faced a confluence of events over the past year that demanded international coordination in several key areas, and that's precisely why the FSB was created more than 10 years ago, a beacon at the end of another fateful march. The span of territory and topics covered can seem bewildering at times. I'm sure it did in the overview I've just given, and I covered only a few of them today. But as the FSB builds its agenda for each coming year, the process is like a pointillist painting. Each topic, viewed by itself, is a series of complex data points, but on stepping back, we see the connection and interdependence of the various elements. The role of the FSB is to orchestrate a unified image and a coherent approach to ensure that we continually monitor and address those hazards, the shape and form of which we've already identified, while allowing for vicissitudes like the COVID event, which arise quickly with little notice and that require extra space on the canvas. There's little margin for error in doing this. Achieving our objectives requires the utmost in diplomacy as well as rigorous analysis. And in light of all the challenges we've faced over this extraordinary year, I'm proud of what my colleagues in the FSB have done. My fellow public servants from around the globe working on FSB topics have been steadfast in their daily pursuit of a unified mission to promote international financial stability. And I think the work we laid out for 2021 does just that. Thanks. And I'll be glad to take any questions, Adam, whether on FSB issues or Federal Reserve issues or anything else you have on your mind. Thanks again.
Thank you so much, Randy. As you said, you as chair of FSB with your colleagues from around the world are dealing with an incredible range of, you use the term bewildering, topics and technical issues. I, even as a former central banker, this gets a little tough going for me. So I'm going to ask you to sort of go back through some things and explain more. In particular, let's start with, you've mentioned the FSB has a report coming on non-bank financial intermediation, part of which used to be referred to disparagingly as shadow banking. What can you tell us about ideas of activities-based versus firm-based or institutional-based regulation, especially since, as you said, there is this constellation of different entities in the same space effectively. They're taking up more and more of our financing, but they're very differing in nature. How do you see that issue?
So, I think that's a great question. There have, over the years been, among folks who think about financial stability policy, academics, policymakers, many, there's been skepticism expressed about the sort of objectives and worth of the activities-based approach. But I think if you look at the fault lines that were thrown into particular relief in March of 2020 in the non-banking sector, I think it emphasizes that it wasn't that there was any particular globally systemic behemoth, the failure of which we were concerned about potentially triggering further instability, that we could have perhaps prevented had that behemoth been designated as an entity in advance. Rather, there was a network of activities being conducted by many players, none of which were probably systemic in and of themselves, but the activity of which clearly was systemic. And I think that it emphasizes that, particularly in non-bank finance, an activities-based approach is going to be necessary. Perhaps in some cases supplemented with entity designation, but really principally it's focusing on the activities and the interconnectedness of many individually non-systemic players that's going to be needed to have a picture of and a response to potential instability in the non-bank sector.
Thank you. And sort of the flip side of that is, and I was going to ask this even before your remarks, it looks like the traditional banking sector has weathered this particular March and last March reasonably well. So without asking you to compromise security on the forthcoming analytical report, I mean, what do you think was different this time? How much do you think it is regulatory and supervisory changes since 2008 that made a difference? In particular, in your preview, you mentioned the idea that there does seem to have been some beneficial effects against too big to fail and moral hazard. For those of us who understand those concepts but are not supervisors, how can you tell?
In some ways, the proof is in the pudding. We had, the banking sector was a source of strength in this crisis. We took some measures at the outset because of both the high level of uncertainty and because this was the first real test of the post Great Financial Crisis system, if you will. So we took some additional measures on top of those that the system itself would have required. I'm referring specifically to the limitations we put on the return of capital from the banks during the crisis itself. But it's clear, that was a wise thing to do, given that this was the first test and given that it was kind of a world historical event that we were facing. But you had a system that was strongly enough capitalized that even when it took really quite dramatic reserves in the second quarter, which was, the size of those reserves, in fact, was driven by some accounting modifications in the wake of the Great Financial Crisis, both IFRS 9 abroad and CECL in the United States. So they took very large reserves that under the current accounting methodology were their best estimates of the entire loss that they could be expected to take, and they still remain very highly capitalized, although those reserves, hit their capital. So, and indeed, their capital grew over the course of the year, notwithstanding the very large reserves that they took. So I think the key reforms were the much higher capital and liquidity that required of institutions. I think that the wisdom of that was borne out in the strength of the banks during the crisis. I would say as well, there's been some, hand-wringing sounds excessively dismissive. So let's put it in the correct light, which is to say there have been appropriate questions asked about the modifications, the sort of refinements and recalibrations that we've been doing in the United States over the last 3.5 years to that post-crisis framework. We said that we intended to do that in order to improve the efficiency without undermining the resilience of the system. And I think, again, the performance of the system in this very strong test has demonstrated that we did that.
So in that sense, there, as part of the capacities that Congress and the Fed built in, there is a countercyclical capital buffer. Was this a de facto use of it? Are there periods in which legally you can, not legally, but legally de jure using it, Because it hasn't been used so far officially. I mean, when would the countercyclical capital buffer come into play?
So that's an interesting question on which the COVID event itself has caused my views to evolve somewhat. So in the United States, at least, we had, our capital levels were very high. So, the way I took to framing that issue was that effectively we had turned our countercyclical capital buffer on already because our capital levels were really the highest in the world. And our problem was going to be turning it down in a time of stress because we had done that through calibrating our through the cycle measures as opposed to adding a countercyclical capital buffer on top of it, because every time we looked at the situation, it was, well, we have enough capital. We shouldn't be increasing capital further at this point. I think that's exactly how it played out. We had to take some emergency measures in order to ensure, in order to help ensure proper market functioning, such as the changes we made to the supplemental leverage ratio, which were helpful there, and that served the function of. It was a quasi turning down of a countercyclical capital buffer, if you will. Had we been in a position where our through the cycle capital levels had been lower and we had turned on that buffer and then been able to turn it down, as was the case in many other jurisdictions. But the reason I say that my thinking has evolved is that when you look at some of those other jurisdictions that were in a position to have turned on their countercyclical capital buffer going into this stress and then turned it down, it didn't actually prove to be that useful in creating the space for those institutions to continue to lend through the crisis. There were, I would say it is a topic on the international agenda currently that the Basel Committee is certainly looking at, and that we're interested in at the FSB on the use of capital buffers and buffers generally in a period of stress, because it was clear that, and this was particularly the case internationally, where they had turned the buffer up and turned it down, you still didn't have banks that were willing to eat into their capital buffers in order to expand lending. They said that things are going to go back to normal pretty quickly. The market will punish us if we do it. A variety of concerns that led this framework not really to be that effective in encouraging lending during a time of stress. We didn't run into a lot of that issue in the United States. There's not currently a significant problem with sort of unsatisfied credit demand from creditworthy borrowers. But had there been the excessive demand that we thought there might have been, one of the reasons for that is because of the very significant amount of fiscal stimulus that has been put into the economy, and had the banking sector had to pull through more of that in forms of providing that lending support, we might have run into the same issues here. So I don't know what the answer to that is. We're wrestling with that, but that's more color around the countercyclical capital buffer, and is it really going to be an effective tool going forward?
That's terrific. Thank you for explaining that. I'm aware that we have 10 minutes left, so we're not going to go quite to a lightning round, but there's so many topics we want your views on. One thing in this crisis a year ago was that the Fed's network of international swap lines with other central banks, and then via the New York Fed to a whole different set of central banks, and in my view, and many observers' view, was a huge success in preventing liquidity problems during the crisis, or during the initial economic impact of the COVID pandemic. So is there anything that you at the FSB or you all at the Fed are thinking about to build out that institution to make it more sort of regular? I don't mean more frequent, but I mean less ad hoc in its usage in future? Or is this something, it worked beautifully and you're happy with it? I mean, how do you build on this success?
So So it's not really a topic at the FSB currently, although I agree with you. It was critical to maintaining global financial stability in the early months of the event. And we're always looking at ways to improve the efficiency of what we do. But I myself, at least, think that we have seen that the use of the swap lines, both in the crisis of 2008 and in March of 2020, worked pretty well. So institutionalizing it, I'd say, is not, I don't think that needs to be a high priority for us because it has worked pretty well. I do, and we've been able to roll it out pretty quickly, particularly in 2020. So so I guess I'll just leave it at that.
Turning again on international and more to the monetary sphere, although obviously financial stability as well, I'd like to ask you to comment on the issue of central bank digital currencies. The two largest, or arguably largest monetary zones after the dollar, the People's Bank of China, the Euro area, are both doing, the central banks, the ECB and the PBOC, are doing pretty out there public intents to develop their own central bank digital currencies, to foment them. The Fed has not. Governor Brainerd has spoken on this issue. Tomorrow we have, as I mentioned, Augustin Carstens of the BIS giving a speech to central bank digital currencies. With your financial stability hat on, both at the FSB and at the Fed, how do you view central banks stepping into this realm?
Well, so I think that let me speak about this mostly from the Fed point of view. My position as a governor, I think that's something that technological developments are something that we should be on top of, and we should certainly be looking at that at the Fed. I think we have to be clear in doing so that we have framed the issue that we're trying to address with central bank digital currency. And I do think that in a lot of the efforts globally to look into this issue, that that fundamental question of what are we trying to do with this is not clearly answered. And I think the benefits in a country like the United States of CBDC, they certainly they may exist, and we should be active in looking into them. But I don't see an urgent flaw in our system that a central bank digital currency would fix.
I'm just going to press you a little bit on this. My own personal views, frankly, are similar to what you just said, but there is a concern which our colleagues, Marcus Brunnermeier, Jeremy Landau, and Harold James have raised, among others, that if we start having very solid central bank digital currencies, it could suck money out of more fragile currencies in emerging markets and developing countries. Again, in a sense, that's not narrowly your mission as the Fed or the FSB, but it seems like it's something to at least consider. Is this a topic you worry about at all, or does this come up in your discussions with PBOC or ECB?
I think it's a topic. It's a relevant topic. It's a relevant issue to consider in the broad range of issues to be considered. I mean, obviously, I think our primary concern has to be, the usefulness and benefits, and as well as disadvantages and costs of central bank digital currency for the United States, principally. But we're not unmindful of the potential knock-on consequences. Some of those are for other countries. Some of those are for the financial system itself. I mean, concerns about potential disintermediation of the financial system and what the financial stability consequences of that might be. And again, I think we just one of the most important early tasks will be coming to a clear and shared understanding of what exactly we'd be trying to achieve. And I don't think that is either clear or shared yet.
Thank you for being frank. One of your roles and the Fed's roles is interacting with other U.S. regulatory and supervisory agencies through the Financial Stability Oversight Council. Coordination among the regulators and supervisors a year ago, March, seemed to go pretty well at a time when the Trump-Mnuchin Treasury had cut back a lot, it seemed, on the staffing and support for the FSOC. How do you see the FSOC developing over the next couple of years? Is it a priority to rebuild that, or is it worked when the push came to shove, so I'm not going to worry about it?
Well, I think that's an interesting point. I hadn't really even focused on that. I think the FSOC can be a useful mechanism. It's particularly a useful mechanism, though, for and I support whatever direction Secretary Yellen wants to take the FSOC in. Right, I suspect that she will that she will be more active, or the FSOC will be more active, or take on perhaps a broader range of topics. And I think that it can be very useful, but I think it's particularly useful in peacetime. In just the nature of the organization is very large. You have all those people around the table. It fills the entire Secretary's large conference room, and that's a big room, as you know. And you've got a lot of, there are lots of folks there with varying levels of, engagement on particular crisis actions. So, in a time of crisis, I don't know that an entity like that is really a crisis management mechanism. There's going to be a lot more, that's going to depend a lot more on bilateral, agency to agency action, the core group of agencies most involved with whatever is the core generator of a particular crisis. But in peacetime, in ensuring that you're looking at the broad financial sector, and thinking about what risks there might be and how regulation can be, or supervision can be refined or improved to enhance the resilience of the system. Those are questions like, are you designating a particular non-bank finance activity? That's not a crisis response. By that time, it's way too late to think about designating an activity. You ought to have been doing that before to ensure that you're ready for weakness in that activity, or questions about designating particular entities. So I think that, in my view, at least, the FSOC is a useful organization, but more of a peacetime organization than a crisis organization. I think you're absolutely right that the crisis management from last year was largely non-FSOC and was largely very effective.
Thank you. Just as a final question, you've covered so much. But of course, as part of your day job, you're also a voting member of the FOMC. So one question about your views on monetary policy. You and your committee members, your fellow committee members, announced a new strategic framework for monetary policy at the end of August last year. We got to discuss it with your counterpart, Vice Chair Clarida, at that time. For you as an FOMC voter, how does the new framework imply any difference in your vote, in your planning, as you consider raising rates in some future date? How do you view the framework, either constraining or enabling you differently? And also, just one more thing, if I could, how is it credible that the committee is going to allow an overshoot of the 2% target for any period of time? Is that a credible commitment from the committee, or does that commitment not exist?
So, so let me take. There were a number of things there, so let me take them all, and let me take them in order. So the framework does change how I at least will respond to, I'm one of the optimists on the committee, but very optimistic about the likely evolution of the economy over the coming years. Probably in the near term as well, but certainly over the coming years, over the horizon that we project in the summary of economic projections, for example. And under our prior framework, that level of optimism about the outlook and about the projections for a lowering unemployment rate, and as well as some other views that I have about the possibility, indeed likelihood, of a steeper Phillips curve over the coming decade as opposed to the previous decade, would argue for moving sooner rather than later in beginning to withdraw accommodation under our old framework. Under the new framework, an optimist like me, and I think this is right, I'll talk a little bit about that in a moment. Under the new framework, the fact that my projections are optimistic and that I see, I would project that the unemployment rate will fall, pretty quickly and substantially, would argue for beginning to act now. Under the new, I'm sorry, that's the old framework. Under the new framework, we would wait to see that you actually see movement. You would wait to see that actually comes down. The fact that I am an optimist is not really relevant under our new framework. It says, well, I believe we'll get to that point where we're seeing those outcomes sooner than others, but we shouldn't jump the gun. Let's wait until we see those outcomes. And clearly the performance of the macroeconomy and the performance of monetary policy over the course of the last, not just decade, really even 15, 20 years, would argue that leads to superior outcomes. I've said this publicly before, I'll say it now. One of the major achievements of Janet Yellen when she was chair of the Fed, and I was very skeptical of this, I wasn't on the Fed board at the time, but very skeptical of allowing sort of the unemployment rate to fall as low as it did and continue to fall as low as it did, while being quite gradual about raising interest rates, not raising them for a long time. And we saw the benefits to the labor market of doing that. We did not see concomitant inflation. And there were many more people, particularly in kind of the lower echelons of the labor market, that were drawn in and benefited from that stance. So I'm very supportive of our new outcome-based framework. And really, I think that will be true of the committee. I think it's very credible to expect the committee to be comfortable with inflation somewhat over our 2% target. I myself don't believe that we need to have some sort of mathematical equivalency. If you go 3 years below by 20 basis points, you've got to go 3 years above by 20 basis points. And the framework sort of very expressly doesn't state that kind of mathematical averaging, but rather that over time we will look to average. And I think that's a very credible commitment from the committee, and I'm certainly supportive of it. And as I say, I'm one of the biggest optimists on the committee.
Vice Chair Quarles, Chair of the Financial Stability Board, thank you so much for your depth of knowledge, your sharing your insights with us, your willingness to make clear your views, and especially for your current and past years of public service. We are very proud to have had you with us today at the Peterson Institute.
Thanks so much, Adam. It's great to be here. Thanks for having me.
This meeting is adjourned. Thank you.